Alright, recording now, and it's been a while that I haven't recorded anything, and this video I'm hoping to make it 2 hours and a half video, if not less, a little bit less, 2 hours at least. And a topic I wanted to work on was understanding startup finances, startup laws. How does the board work? Some corporate stuff like that. I'm not sure if it will take. Let me close this and this. Okay. Startups. Okay. First of all, I think we need a note. Okay, let's make this big because you can see. Startup finance. Startup corporate structure. So this will include just how co-founders work, how giving equity works. Okay, just put it in underneath it because you can't really edit in here. How does equity work? What else? How does seats on the board work? How does creating, onboarding, boarding other startups work? We will add to this later as we go, but for now, number 3 will be startup laws and IPs, I think. And I don't know, people going social networking and just suing each other. I hope that's how you're supposed to sue. Yes, it is. What else? So maybe we can add here difference between angel investing, difference between different various ways of obtaining investment. I should use simple language to be honest, because this confuses myself. It stalls my thinking, so it's probably even harder to listen to. And what else could be good? Some statistics about startups, I guess. Because a lot of startups fail, and that's just the way it is. Okay, so we're gonna do this fundamentally. So throw away what we know that, oh yeah, the San Francisco is this, that. Maybe how the financing works in different sectors. Different what if you're an energy company and it's not technology based, but you just, I don't know, you want to just start a company and do something similar, but you have some sort of like secret sauce. I don't know. You have some sort of secret sauce. Um, Here's another one. How to find communities so you can build for. I feel like you need to be cracked for this. Because I mean, not really, but in the beginning, where you're just building something no one else understands. If it's especially um, in the technology space, then it makes sense that you need a community. So when they see this algorithm, they're not like throw it in the garbage. What are you doing with your time? They get it. To be cracked and accepted initially by cracked people, I guess. To be cracked and accepted initially by cracked people. The community is very important. Something's telling me it's all about the community. It's all about community. We have auto-completion in text. I guess anywhere that keyboard works, Apple is completing for you. Maybe some strategies, some different strategies to obtain financing, how to create that story. So yeah, if we can maybe tell them, oh, phew, this has never been done, it's the coolest S in the world, that probably gives you a better advantage. Or if you're saying, oh, yeah, the others are doing it, but we're doing it with a 20% extra amount of money, or we have this other plan that, oh, this, and go into the details. Maybe you can do that better. Stories of Alright, we need to check out some startups and their stories of getting finance. Yeah, so maybe how to create a story. Is it better to be dull? Oh, we are making this chip that it does this thing different, has this process, and it does this thing different, and it will be in so many component electronics and this and that it will change everything by 2%, and it's worth to work on that 2%. Or is it better to be dull? Is it, okay, I'm gonna use the word, is it better to be sexy? How to know your investors, I guess. This is more or psychology, but I feel like we can't fill out that 2 hours that we have. Startup, corporate structure. Yeah. Or else it's on the board. Startups work. How does merging with other companies work? Okay. Suing each other. Contracts. Can have here. Some style about startups. I don't know. I feel like some style about a startup. It's something that's a process, not the content itself. So if you try to be more content oriented, more product oriented, okay, yeah, the status of 80% guys, 20% women in the company. It might give you like some heuristics. Oh yeah, 10 PhDs led by an MBA. I don't know. It could be explored and analyzed, but I'm a little bit suspicious. If you can do the work, you can do the work. End of the story. This community is fun. I feel like this is gonna be a little bit philosophical and what is fun, what is not fun. If you ask what is funny or not fun, you do fun. It's gotta be. I think it's obvious. I don't know. If you're asking how to be happy, I don't know. Maybe yes, maybe no. I don't know how I feel about that. But okay, let's go through our list. Startup finance. How does startup investing work? Funders Club. And then we have Republic Europe. And we have Equity Investment, a guide to seed fundraising. The risk and rewards in the startups. Okay, VC 101. This is not bad. This is a book. It is a book. To make this bigger. Someone's watching video, actually, they can see it. Okay, VC 101. The Angel Investor's Guide to Startup Investing. The risks and rewards of startup investing, understanding venture capital, startup incubators versus startup accelerators, angel investors, online VC, equity, crowdfunding, and who can invest in a startup, accredited investor qualification. Let's go actually check out their education center. Angel investing, startup investing, take a startup. These guys are reading some stuff. Foundersclub.com. So, where do these guys come from? Portfolio. Instacart. Coinbase. Slack. Oh, are these guys a VC? Looks like it. They put the best thingies on the top. Slow company. Let's just go to the end of this. Okay, what we do community? Who are the people? Investors. Are startup fund founders, investors, and operate relentlessly focused on creating the best online venture capital experience. We're backed by the world-class VCs and angel investors. First round, Founders Club, Intercapital. These images are, oh, well, maybe I'm too zoomed in, but oh, here we go. Pageman knows I think I know this guy, isn't he? In Pair Capital Pension. Yeah, was in Pair VC. Was Chris Dixon is a general partner in Anderson Horowitz. Aaron Levy, and I see a box. And Box develops and markets cloud-based content management and collaboration and file sharing tools for businesses. 2005. Alright, trust them by Works Organization. Fair enough. BP Partnerships, Bobby Yaslani, Airly. Well, I didn't know Bobby. Zod Nazim. I feel like a lot of these guys are Persian. A lot of these guys. Bobby Nazim. Bobby Yaslani and Zod Nazim. American entrepreneur and investor. He's in Kota Capital. And of course, he's in San Francisco. And organization founded is Sabo Software. That's probably his daughter name. I put my money on that. But let's see. He's an Iranian American entrepreneur investor specializing in early stage private US based modern enterprise technology companies. Founded Savos, a provider of human capital management software solution. He took the company public in 2000. Yazdan founded Signatures Capital in 2006. He co-founded investment firm Kota Capital in 2014, where he serves as a partner. Yazdan was ranked 1 out of 2,000 angel investors in 2014 report by CB Insight as having the most track record for investing in companies that receive follow-on funding. Yaslani began investing in 1989 and is an early investor in companies such as Google, Dropbox, Clouds, Salesforce, and Google. Okay. Oh, it goes the other. Okay. Nice to see some Persian faces. Zod Nazim. Here we go. Tehran, Iran. Let's see what he did. Was Yahoo's CTO and one of its longest serving executives. On May 30th, 2007, at age 46, he announced that he would retire and leave Yahoo. In June of that year, since retirement, Nazim has spent most of his time on investments, philanthropy, professional mentoring of young entrepreneurs in the technology field. That's interesting. Nazim began working at a young age and paid his way through college. At the age of he graduated with highest honors in Polytechnic State University. That's not Caltech, is it? Upon graduating, he was recruited by Rome Corporate, a revolutionary company of the time. Nazim started his technical career in the VLCBX division at ROLM Corporation, producing large computer-based telephone switches. He was soon recruited to join CIDIX, And see this. Okay, let's take a pause. Cracked people are in this thing. Um, I checked out the Persian guys, but I bet these other guys are as cracked. Yeah, good enough. Alright, let's just go to the content. Go back. Join Founders Club for free. How's that? Alright, here we go. Alright, so okay, we are going from foundation. What is a start? The world is so much more convenient today than it was at the turn of the century. No need to leave the house to shop for groceries or step off the curb. What are we doing here? This is the risks and rewards. Let's go to understanding venture capital. Successful VCs have mastered the art of spotting one of the lucky few startups that make it big and betting on them when it's too early to tell whether they'll succeed. Venture capital firms, VCs, are money management organizations that raise money from various sources and invest this collective capital into startups. VCs raise these funds from family offices, institutional investors, pension funds, university endowment funds, sovereign wealth funds, etc. And high net worth individuals with assets over 1 million who allow the VC firm to manage their investment. Okay, the size of VC investment in a given startup can vary widely based on the particular investment theory and practices of each firm. The influx of VC cash, along with the additional resources, advice, and connections VCs can provide, often serves to help startups to grow rapidly and dominate their market. VC firms typically make investments according to a particular thesis, for example, supporting startups in a particular stage industry. Okay, so kind of getting our answers. Okay, answers. Let's make this. Of course, there are different VCs. There is a VC for everything. Alright. For example, supporting startups in a particular stage, industry, or geographic region. Examples. What is this actually? They give us examples. Union Square Ventures is a notable VC firm toting a portfolio packed with big hits: Tumblr, Twitter, and Coinbase, to name a few. USV, Union Square Ventures. USV invests according to a particular strategy, concisely summed up by partner Brad Burnham. I see. That's Union Square Ventures. He's still working in information technology with AT&T. Spawn Ecologic out of Bell Laboratories in 1989, joined AT&T Ventures in 1993. Brad co-founded Takoda in 2001 before joining Fred to create Union. Brad majored in political science at Wesley University. He's married with 2 kids and lives in New York City. Interesting. Oh, let's see if they have job. They do have a job. Oh, these are their companies. I see. Okay, fair enough. Let's see their people for a second. Albert Wenger. We have the Brad Burnham. I see. partner. Who's the other co-founder? Brad is one co-founder. Maybe they are not in the VC anymore. Okay. USV invests according to a particular strategy, concisely summed up by partner Brad Burnham in and that became the firm's official investment, investing in large networks of engaged users, differentiated by user experience and defensible through network effects. I don't know. I'm learning investing strategy instead of learning the contract things, but it's okay. We still have time. This means that USV looks for companies that can scale, like Twilio, bring together huge groups of people, or connect to marketplace, like Twitter, provide a seamless user experience like Codecademy, and thrive off the network effect. The more people who use it, the more valuable the tool is. Fair enough. This is particularly concentrated approach to VC investing that has served USV well. In 2015, US-based VCs raised about $28.2 billion in total and deployed nearly $60 billion to 4,561 startups, according to the National Venture Capital Association. That's interesting. There's an association. Should I tweet that? Should I tweet now? No. Alright, no. There is an association. What is that association? Okay, as a point of comparison, all US-based angel investors, individual investors who directly invest their own money in the startup, raised and deployed over $24 billion in 2015, spread throughout more than angel investors raised and deployed 24 billion and VCs raised 28. The institution almost did the same, and the angel investors invested in 71,000 companies. That's crazy. This demonstrates the longer lifetime of venture funds, which are generally deployed over a period of several years, and the smaller average check sizes of angel investments versus venture investments. Okay, kind of leading to what we want. It can be near impossible for new investors to get access to top startups through proven VC firms. Each fund has a limited number of spots for investors, and many top-performing VC firms already have a backlog of previous investors who get top priority on their new funds. Okay, so is that how it works? People are killing themselves to give their monies to VC? Is that what it is? Because they have a backlog of investors who want access to these pools, and those pools get invested to the startups, I guess. There's too much money in the world, no one wants to work, I guess. Parties that invest in VC funds give their money to experienced fund managers who are responsible for investing their capital in high-promise startups and making a competitive return on the investment. VC funds are pools of money collected from a variety of investors that a fund manager invests into a collection of startups. A typical VC firm manages about $207 million in venture capital per year for its investors. Alright. I mean, these are from 2015. Alright, on average, a single fund contains 135 million. The capital is usually spread between 30 to 80 startups, though some funds are entirely investing into a single company. Others are spread between hundreds of startups. Okay. Who invests in venture capital funds? Parties that invest in VC funds are known as limited partner. Parties that invest in VC funds are known as limited partners. General LPs are high net worth individuals, institutional investors, and family offices. Breakdown of LP capital invested in VC funds. Majority institutional. Okay, so limited partners is LP. Majority institutional. Okay, so most of it is institutional. Pension funds, endowment funds, institutional fund managers will generally invest some of the capital within VC funds with the goal of achieving a certain overall percentage of return, say 15% increase each year. Small percentage from high net worth individuals, individuals with a net worth of over 1 million in liquid assets who invest their personal wealth in startups or VC. Many VC funds limit participation to individuals who clear individuals who clear. Okay, so the more money you have, the more say. Fair. David F. Swenson, manager of Yale's $25.4 billion endowment fund, pioneered groundbreaking investment strategy. Okay, maybe we need to write some names down. Brad Graham, Bobby. I don't know that one, but he's Persian. People come back to me. All Persians are. Swenson, manager of Yale's $25.4 billion endowment fund, pioneered groundbreaking investment strategies. In 1976, he diversified the fund, then composed of stocks and bonds by including multiple asset classes, and led Yale to become one of the first universities to invest in venture capital. Oh, see, like I have a suspicion about this, so now everyone's like, oh yeah, diversify. But the first person who got it right, he went against the tide and got paid off for it. So don't look at the success. Look at the timeline. Look at what happened. Look at the whole information. Alright, let's see. Oh yeah. Well, I'm gonna add taxes here. Taxes and government subsidies. Okay, venture capital went on to become Yale's best performing asset class, generating a 33.8% annual return from 1976 to the present day. Yale's endowment is packed with tech giants like Amazon, Google, Facebook, Pinterest, Snapchat, Uber, Twitter, and Airbnb. David F. Swenson. Yoga. Is this still working? Oh. That might be a good book. Pioneering Portfolio Management, Unconventional Success. Fundamental Approach. These might be good books. He was the chief investor until his death. Alright. 46, 67. What happened? Simple books. At a PhD, Wait, what? Oh, his father was a chemistry teacher. Anyways, venture capital went on to become Yale's best performing asset class, generating a 33.8 annual return. Excuse me for that. Venture capital now makes up 16. Oh yeah. Venture capital now makes up 16.3% of Yale's overall investment portfolio, and its endowment fund generates of the university's overall budget as opposed to 10%. Oh, generates 33% of the university's overall budget as opposed to 10% before Swensen's management. That's solid. That is solid. Okay. Who manages venture capital funds? VC firms will typically employ one or many fund managers or general partners. Okay, you see, the guys who manage the funds are general partners. To run their funds, GPs are responsible for making smart investment decisions and maximizing returns for the LPs. There's no way to change the light. It's alright. GP responsibilities include raising funds from limited partners, sourcing top startups, performing due diligence, investing fund capital in high promises startups, delivering returns back to investors in the fund, and limited partners, providing value add to fund portfolio companies beyond just capital, including introductions, advice, introductions to follow-on investors, etc. VC funds tend to be large, ranging from several million to over 1 billion in a single fund, with the average fund size for 2015 coming in at 135. Okay, so there are multiple funds, and the average size is 135. What is the median? The median could be a better. You need both. Anyways, investing in larger VC funds comes with advantages and disadvantages. Experience. Experienced VCs with inside knowledge manage your investments. Most large funds include a diverse base of companies. The fund has follow-on capital on hand to deploy. Successful successful portfolio companies looking to raise capital, raise additional funding, which maximizes the investor's equity stake in already proven successful companies. Large funds tend to invest in later stage startups which have a lower risk of failure than seed and very early stage companies. Okay. Different stages. Startup, seed funding, and early stage. Okay, so there's that. Huge funds. Cons. Huge funds frequently fail to deliver market-beating returns. So there is sometimes more capital to deploy than high-promise startups to invest in. Large funds are less likely to invest in early-stage startups, which are a riskier investment than later-stage startups, but have a greater potential for outsized return. Like individual startup investors, fund managers tend to diversify each VC fund by investing in multiple startups. Like individual startup investors, fund managers tend to diversify each VC fund by investing in multiple startups within different industries in order to maximize their chances of landing on a startup that generates returns which more than compensate for all failed investments. Okay. VC funds. VC funds are structured under the assumption that fund managers will invest in new companies. Um, the fund manager will invest in new companies over a period of 2 to 3 years, deploy all or nearly all of the capital in the fund within 5 years, and retain all the capital to investors within 5 years. Where are these numbers coming from? Oh, interesting. Paul Kedrowski. Interesting. Let me take you. Going back. It's good that we have these links. Honestly, put this together. It's good stuff. Okay, 2005 final power restoration. Raised low. Oh, here we go. Am I getting this right? Oh no. We are. Sorry for delaying it. Oh yeah, assumptions. Maybe we should have started with the other one. Actually, skip the chapter. We need to go back to chapter 1. What are we doing? Okay. And retain all capital to investors within 5 years. Funds have a long lifetime because it usually takes years for the startups they invest in to mature and grow in value. For example, many general partners will hold off on closing out a fund by liquidating the investments within it if a liquidity event has not yet occurred for promising startups within the fund. So, wait, what funds have a long lifetime because it usually takes years for the startup they invest in to mature and grow. For example, many will hold off on closing out a fund by liquidating the investment within it if a liquidity event has not yet occurred for promising within the fund. Okay, so they wait. Alright. In exchange for investing your money and managing the fund, VC firms typically charge management fees and carried interest. Okay. On a percentage of the profits made on fund investments, sometimes even more, I think. This is referred to as the 20 and 20. Why do you do this? It's for Congress. Come on, man. It was good till that 2021. Okay. VCs typically charge. Is that like something with search optimization? I don't know. To put this link here, I guess. No, because that worked this time. Okay, it could be a mistake. VCs typically charge 2% of the total fund size per year for management fees, the operational and legal costs required for the fund to operate, and 20% carry on any profits the fund makes. 2%. The operational and legal costs required for the fund to operate, and 20% carry on any profits The fund me. Okay, top VC funds sometimes employ a 3 and 30 model and are able to justify these higher, so 3%, 30% of fees because their track record still leaves investors with greater net returns. In 2003, Sequoia Excite Fund raised 387 million from about 40 limited partners, mainly institutional investors. Okay, so Sequoia. I don't know how to. This is the mouse I'm using. Okay, so they had 400 almost million from 40 limited partners. And in 2014, Sequoia closed the fund and reported 3.6 in gains. 3.6 billion in gains, or 41% annual return. Sequoia Partners collected 1.1 billion in carry-on, 30% of all the gains, while LPs received 2.5 billion, 70% of the gains. Ooh. Well, these are institutional. Well, let's see who Sequoia has. Sequoia Capital. Let's go to their website. Spotlight. Who's so scared? Designing Germany's robotic. This is what I'm talking about, man. This is what I'm talking about. Like, who are the people? Seed and early growth operator. We have Bogomil Blansky, Julian Beck, Elof Botha, Konstantin Buller, Josephine Chen, Bill Kuguran. I shouldn't know these people. Charlie Kernan, Jim Goetz, Jess Lee, Alfred Lin. Alright. It's interesting. Why have never Googled these guys? And the team looks a good dynamic, honestly. It feels like has the wisdom of the old and then the courage of the young. Alright. How many people? Let's see. There's way more people. There's gotta be way more people. Yeah, these are just VPs. And probably fund managers, the heads. Arc? Where's Arc? Pictures? Actually do have stories out here. Maybe we should read some. Okay, so our team, our companies, Reddit, NVIDIA, YouTube, Instacart, Apple, Owls, Square, Vlog, Snowflake, Venta, SpaceX, Retool, Zoom. You know they were doing good when they designed their own thing for the top performer. Google, Unity, HubSpot, Cisco, Instagram. Fair enough. Fair enough. They don't even have that. Oh, these are spotlights. It's like, don't even have dashboard. Dashboard? I feel like it's called dashboard. Oh, here. Ooh, they have 23. Alright. They have a lot of information out there. It's really worth probably analyzing, getting to know. You don't feel spotlight. Our founders. Oh, the founders of the companies. Yeah, DoorDash, Hugging Face, Otter. It's insane. Cool. AMP Robotics, Zipline, Keller, Ronaldo. Alright. Fair enough. That was a little bit of Sequoia for you guys. Okay, and then 30% of gains, they netted 1.1. They made 2.5 for the. What is the Sequoia? But they closed the fund. Which one? Excuse me. Just taking this all in. Okay. Investors in a VC fund profit if investors in a VC fund profit if the returns from successful startups outweigh the losses from failed startups. This does not mean that the majority of the startups within the fund have to be successful. Often, one big winner within a fund can make up for a portfolio full of losses. Fund managers can choose to liquidate all or part of the fund in order to pull the capital out and distribute profits to investors. This can happen when a company within the fund IPOs is acquired, etc. Generating market-beating returns depends heavily on investing in top VC fund with no connections to top startups, proven returns rather than spreading capital across multiple funds, as the highest returns are concentrated among the top quartile 25% of funds. According to a report by Cambridge Associates, the median of all VC funds sometimes outperform and sometimes underperform public market benchmarks, such as the SP 500 from 1981 to 2014, while the top quartile of VC funds have consistently outperformed the S&P 500 in the last 3 decades. Okay, so top quartile is 24%, median is 12%, which is good, and S&P has been 12% almost. Okay, and there's also the quarter, 4 sections. So if the median is that means half of the fund goes to bad investments, and the other half goes to more than this. I think it's worth the gamble, because if you're doing it sort of randomly, not randomly, that takes so much effort that these guys have put in. But one is no effort, one is effort. So the real winners are VCs here, I think. Maybe the average is higher. I don't know. I don't know, with the market crashing right now, I don't know. Actually, not quite sure what to say. Okay, VC versus public market returns. 1995, that's VC, top VC, medium VC. Okay, they do alright. They do very alright. See, the top VCs never bought one. Median VCs are under S&P, which is not a happy place to be. And then you have, okay, it's good enough. Can this come forward? Okay. Venture, however, while the top 25% have pulled in 25% in internalized rate of return. IRR or internalized rate of return is the firm's estimation of the annual percentage returns. Okay. This is how much they expect. Over the past 3 decades, the top 2% of funds, the 20 best performing funds, consider pulling between. Okay, so there are some winners, but we keep talking about winners. However, while the top 25% of VC funds have pulled in, oh, I want to see some losers. It's like what Warren Buffett says, right? Yeah, there are so many car companies, and you don't know which one to invest in, but for a fact, horses are going out of business. So there's that. Even when the median is much lower, this is an example of power law distribution. In venture capital, power law distribution dictates that the most successful funds will generate a higher return of rate of return than all the other funds combined. The second best fund will generate a higher return than the third best fund and all other funds combined, and so on. Sort of seems like exponential. Startup performance also follows this trend as discussed in chapter 1. Wealthfront studied 1,000 VC funds and found that the top 20 funds, 2% of funds, generated 95% of the returns across 1,000 funds. That's insane. That is insanity. Wealthfront, interesting. What are those guys do? Industry. Wealthfront.com. No, they do. Planning. Product news. Investing. Seems like a fun self. Okay. So maybe these guys have some nature. Whatever, not going back. I don't get it. This is the mouse. Okay. Fortunately, top VC firms are nearly impossible to invest in as a newcomer, as the original LPs often become repeat investors and space in these funds is extremely limited. Oh, interesting. Why do startups raise VC money? So you're kind of vibe checked. That's it. That's good. How do startups raise VC money? Venture capital is an ideal financing structure for startups that need capital to scale and will likely spend a significant amount of time in the red to build their business into an extraordinarily profitable company. Big name companies like Apple, Amazon, Facebook, and Google were once venture-backed startups. Fair enough. Unlike car dealerships and airlines, companies with valuable physical assets and more predictable cash flows, startups typically have little collateral to offer against a traditional loan. Therefore, if an investor were to issue a loan to a startup, there is no way to guarantee that the investors could recoup the amount out of the start if they've lent out if the startup were to fail. By raising venture capital rather than taking out a loan. Also, it's really known. It's really important to know what to do. Okay. By raising venture capital rather than taking out loans, startups can raise money that are under no obligation to repay. However, the potential cost of accepting that money is higher, while traditional loans have fixed interest rates. However, the potential cost of accepting is higher, while traditional have fixed interest. Startup equity investors are buying a percentage of the company from the founders. This means that the founders are giving investors rights to a percentage of the company profits in perpetuity, which could amount to a lot of money if they are successful. Okay. The cost of raising venture capital. The cost of raising venture capital. Startup investors generally expect a 20% or more yearly return on their investment and will take this number into account when determining how much to offer you for your business. The lender will typically charge 7.9 to 19.9% at face value. It may appear less costly for a startup to take out a loan. Wait, what's my brain's startup investors generally expect a 20% or more. Okay, we'll take this number into account when determining how much to offer you for your business. A lender will typically charge 8% to 20% at face value. It may appear less costly for a startup to take out the loan. However, most startups do not qualify to receive loans at all. Oh, okay. Okay, and your collateral is so the business will be accountable for the loan. Is that what it is? Is that what it is? I think so. However, most startups do not qualify to receive loans at all, and ones who do typically will receive loans with expensive terms attached, such as high interest rates, late fee penalties, and warrants, free equity to the lender. Startups are also often forced to turn over company IP and other assets in the event of a default on payment. Early stage startup investing offers potential for astronomical growth and outsized returns. Relative to larger, more mature companies, this potential can make acquiring startup equity an attractive investment opportunity to prospective investors, albeit a risky one. I want to see how you draft contracts. This is why it's important for VC firms to build a reputation for adding value by helping their portfolios with recruitment, customer acquisition, access to follow-on funding, and advice and other challenges startups encounter. Venture capital financing is also ideal for startups that can't get very far by bootstrapping. Although many founders self-fund their startups while operating out of a cramped apartment until they've reached profitability, bootstrapping does not work for companies that require capital upfront just to build and test their MVP. But for founders who wish to scale their business faster than bootstrapping permits. Alright, fair enough. Startup fundraising rounds. Seed to Series C and beyond. Startups raise venture capital in phases, commonly referred to as rounds. Startup fundraising rounds refer to primary issuance of venture capital instances when investors get a lot of capital together and invest it in the startup in one shot, or at times in two or more increments known as tranches. Startup fundraising rounds refer to primary issuance of venture capital instances when investors get a lot of capital together and invest in the startup in one shot, or at times in two or more increments. Okay, tranches. Each fundraising round is generally correlated with new stage. Alright, 1 second, I have to check Bayern's just UCL score. Okay, PSG is still 1, Bayern is 1, Barcelona 1, Inter there. Need to let my voice rest a little bit because it's going out. Seriously, is the limit of talking 50 minutes? It's unbelievable. Okay. Pretty cool. If I could make the background that's like this. Damn, it's cool. I gotta make that work. Let me manifest it into existence. Because I really have everything that I need, but just I need to keep it simple. Like I need to dominate. Okay. Can I do a drink or something? Maybe. I don't know. Okay. Each fundraising round is generally correlated with a new stage in the startup development and is often tied to a valuation event. Events that affect the startup's worth based on the price per share one would have to pay in order to invest in the company. Common benchmarks according to startup stage. Benchmarks at each financing stage can vary widely for each startup. depending on their industry, geography, and individual goal. Rounds typically range from less than $1 million to $3 million. Have generally demonstrated early traction, need capital to continue product development and acquire initial customer base. Rounds typically range between 3 million to 10 million. Oh, so this stage is less than 1 million. Okay. Usually have achieved strong product fit, market fit, seeking additional capital to scale their customer user base and increase revenue. And the Series B rounds typically range from seeking additional capital to scale their customer user base and increase revenue. Range from 5 million to 25 million. Startups should be able to demonstrate highly measurable results, strong revenue, large market share, repeatable growth engine. Focused on scaling their internal team and achieving market domination. Rounds range from 10 million to 100 million and can generally demonstrate larger scale expansion, focused on developing new products or expanding into new geographies. Subsequent rounds are labeled Series D, Series E, and so on, and are usually spaced around 18 to 24 months apart. Alright, that finished that chapter. And a quick break. Let's just see what UCL is doing. Oh, okay, let's go into extra time. These guys. And well, Bayern is long, so we score. Harry Kane, Alfonso Davies. Okay, let's go. So, Rafinha and Yamal and Nicolas Otamendi. Sounds so familiar. Bayern has 5 stars. Where are Bayern's stars, man? Come on. Let's see. Okay, Atletico is playing well. Okay. Versus there. It's finished. Okay, quarterfinal review. This one is insanely bad. What is this mill for? Tracking, scrolls. Quarterfinal. Did I do that, man? Maybe that. Whatever. Arsenal. Oh, you might play Arsenal. Bayern will play Arsenal. 2, 3, 4, 5. But we're playing. I think so. End of night. Intense flash. Watch it. That's incredible. That's incredible. Okay. We finish this. Let's see the chapters. Startup incubators versus startup online secret crowdfunding campus. Accredited investor qualifications. No school for PSG. Session. Tingle. The attack. Aston Villa is in the UCL. That's insane. Okay. 2 hours. Chapter 2. Should read these two. Let's go for an introduction. Okay, so there's nothing in the introduction. The Angel Investor's Guide to Start Investing. Startups turn age-old industries on their heads. Solve big problems with the click of a button and cash in big if they're successful. Is it Barbie Parker? It is Barbie Parker. Interesting. Let's see, maybe. Eyeglasses, right? Looks more reasonable, but oh, it's for the glass too, I guess. Yeah. Yeah. Not driving, but let's go to risks and rewards. Okay. What is a startup investing? Startup investors are essentially buying a piece of the company with their investment. They're putting down capital in exchange for equity, a portion of ownership in the startup, and rights to its potential future profits. By doing so, investors are forming a partnership with the startups they choose to invest in. If the company turns a profit, investors make returns proportionate to their amount of equity in the startups. If The startup fails, investors lose the money they've invested. Liquidity refers to how easy it is to convert the security, something that you own with economic value, into cash money. Equity is a well-traded public company. Facebook, for example, can be nearly instantaneously traded on the stock exchange and is therefore highly liquid. Equity in a startup or private company is relatively illiquid as it is more difficult to sell. Startup investors make a profit from their investments when they sell. That is so true because you don't believe it, you're gonna sell it, right? The, your act of it, it's enough evidence that you don't believe in it as much. I mean, you can probably have excuses like, oh yeah, we need to invest in this thing, or oh, we need to return our thing, or this or that. But well, whatever you say gives more advantage. It's a pretty advantageous position if you're selling good thing to the buyer. But if you're selling, it's not a good sign. Startup investors make a profit from their investment. They sell part of or part of during liquidity events such as an IPO or acquisition. Also, okay, there's a liquidity event. A liquidity event is an opportunity to turn money that is tied up in equity into cold hard cash. A common example is an IPO, initial public offering. The first sale of a stock by private companies to the public, often referred to as global going public. During successful IPOs, the price per share of a stock rises dramatically from pre-sale values. During successful, the price per share of stock rises dramatically from pre-sale values, increasing the value of investors' holdings and giving shareholders the opportunity to trade their stock on the public market if they want to liquidate, cash in any of their assets. An asset is a piece of property with economic value, owned by an individual, a corporation, or the government, and expected to provide future benefit to the owner. Assets commonly generate future cash flow, reduce expenses, or improve sales. Assets are divided into asset classes, groups of securities, ownership rights, asset classes. A group of security ownership rights that exhibit shared characteristics behave similarly in the marketplace and are governed by the same laws and regulations. Startup equity, for example, is regarded as a high risk, high reward, high illiquid asset class. This means that investing in a startup equity is very risky because many startups fail to return investors' money. As startup equity is relatively more difficult to sell before the company IPOs. However, this increased risk and illiquidity is coupled with the potential for a very large return if the startup succeeds. Some startups will allow investors to sell their shares of stock in the company before the IPO, referred to as a secondary sale of stock. However, many startups will issue a right of first refusal, which requires investors who want to unload stock before a company goes public. Uh, Secondary sale of stock. Okay. However, many startups will issue a right of first refusal, which requires investors who want to unload stock before a company goes public to first offer to sell it back to the investor or its early investors. Call it tender offer. Oh, interesting. Most startups also put restrictions on the secondary sale of common stock. Right of first refusal. That's interesting. Light is killing me. Most startups also put restrictions on the secondary sale of common stock or stock held by founders and employees. Example. In 2014, an early Uber employee found a buyer for his currently vested stock at $200 a share. However, Uber refused to approve the transfer. The employee had two options: sell his stock back to Uber at $135 a share, the same amount investors paid in Uber's round the previous July, or hold it. He chose to hold it, which is Uber stock. 7. Well, let's see. Okay, so it's been diluted from what it looks like. Kareem. They made a Dubai version. Drizzly. Interesting. Alright. Okay, oh, sound investors paying. Okay, so the kind of thing kind of gives a structure and rules to this. Uber had implemented a right of refusal and amended their bylaws to restrict any unapproved secondary sales of stock. The buyback program helps Uber to collect the stock issued to early investors and employees at a reduced price and then sell it at a huge profit at later stage investors, effectively doubling as an anti-dilution program. Oh, this is next chapter. So different understandings. Oh, this is investment. Fair enough. This is the easy one. That was the other thing. Here we go. Investing in the startups versus investing in the public market. Timeline. Investors in the public market could theoretically see a return within a few days or weeks. It generally takes 7 to 8 years for a major liquidity event to occur for startups, though smaller liquidity event may occur earlier. Selling the stock. Investors in the public market can sell off their stocks at any time. It is more difficult to sell startup shares before the IPO, as the stocks are often issued with provisions such as as the stocks are issued with provisions such as the right of first refusal and other restrictions on secondary sale. Okay, so if you're private, you have privilege to that, but if you're public, you don't get to say what to do. That makes so much sense. Okay. That makes so much sense. Okay. Return. IPOs have become less common over the last few years, and tech companies are deferring IPO till much of their value has been accrued, making it more lucrative for habitual public market investors to invest in private early stage startups while they are still private. maybe Thursday. I can't go to that meeting. Let's see. First of all, in charge. Um, charging. Okay. High risk, high reward. The appeal of startup investing. Bad news first. 90% of startups fail. Many others will return only the money you initially put into them, leaving you exactly where you started. No loss, no gain. Now for the good news. Investing in one big winner could make up for all of your failed investment and still leave you with an enormous profit. Bonus, the US government provides a tax benefit to qualifying startup investors to help them recoup investment losses. Ooh, interesting. There is more good news where that came from. In the 80s and 90s, most value creation happened for investors in the public market who bought the stock in tech giants like Microsoft after their IPO. Now, however, most of the value creation has shifted to early stage private company investors. In fact, if you were to wait until a startup goes public to invest, you could be missing out on 95% of the gains, which are often accrued by investors before the IPO. Is there? There should be some sort of. I don't know, thinking stock market, there are different markets for the equity of private companies, right? But we can't access it. High. Book it down. Is this in fact? So in that case, you do know. Alright, anyways. So most of the private value creation, as it looks like, comes from the so most of Oracle comes from after going public. Most of even Google is still in 2015. They are doing better. If you just invested in private time of getting fame. Okay, this is because more and more startups are choosing to delay IPOs or stay private indefinitely. Staying private longer holds certain advantages for startups. Startups can avoid activist public market investors who may try to manipulate public market executives or even force executives out of the company. Companies can avoid paying 2 to 5 million in accounting expenses and fees involved with disclosing necessary information to overhead to the public market. That's insane. Startups can avoid the pressure to deliver quarter-to-quarter gains and focus on setting their company up for long-term success. Startups that decide to remain private will often raise 40 million plus later stage rounds that serve as quasi IPOs, creating enormous wealth for early stage investors. Why doesn't MacBook have a SIM card? Let's see. Are there laptops? There are laptops with SIM card. HP makes more sense, but they are expensive. $2,000 for a HP? Are you kidding me? Ooh. Who's this Gibeah? Yeah, 400 bucks. Perfect. 200 bucks. Okay. Okay. In 1976, Steve Jobs and Steve Wozniak sold their most valuable positions. Jobs' VW bus and was programmable calculator for a combined $1,750 to buy the parts that became the Apple I. That 1,700 and 250,000 seed investment by Apple's employee number 3, Mike Markkula. The later investment by Sequoia Capital kept the company running for the next 4 years until it IPO'd at 1.8 billion. Jobs, Wozniak, and Markkula made a combined 436 million in the IPO. In the IPO. Apple then grew from its 1.8 billion valuation to its current 500 2000. Apple was this is insane. Creating over 592 billion value for public market investors, far more than the 436 million made by Apple's early founding team. This is a product of startups at the time tending to IPO quickly at relatively low valuations and to raise fewer venture capital dollars before going public. I'm not getting it. So Apple, the relatively low valuation was like 1.8 billion of like in 1980s. Um, I need to think about this. This is a product of startups at that time tending to IPO quickly at relatively low valuations and to raise fewer venture capital dollars before going public. Twitter, all profits flow to private investors. 2007, Twitter founders Evan Williams and Jack Dorsey Evan Williams were looking for investors to their unconventional social media site EV. Evan invited his personal friend Dick Costolo to invest 25,000 or 100,000. Costello replied that he was on the 25K bus, and shortly after, Twitter closed a 5 million Series A. How interesting Crunchbase has that. Costello became the Twitter CEO in 2010 and led the Little Bluebird to IPO Costello was at a $26 billion valuation, creating millions of dollars in value for early investors. Costello's stake at the time of the IPO was reportedly worth over 300 million. Soon after the IPO, however, Twitter's stock prices started to slump and the company's valuation eventually fell to 12.5 billion. Over the next few years, for investors who bought stock in Twitter when it IPO'd, their investment value has been cut nearly in half. This has been a common trend for big name companies in recent years. Think Yelp, LinkedIn that grew enormously in value while they're private, and stagnate or lose value after the IPO. Okay. Facebook value added for private and public investors. In line with the current trend, Facebook waited until their valuation climbed over 100 billion. Early private investors like private Peter Thiel, who invested 500,000 in Facebook's seed round in 2004, made the vast majority of the gains. By the time Facebook IPO'd 8 years later, Thiel cashed out for over 1 billion. However, public market investors haven't fared so poorly either. If you had invested in Facebook on its first day trading on the public market, your share would now be worth over 3.5x their initial value. For startup investors to make money, their investments have to return 100% of the initial capital invested and then some. To understand the likelihood of making a profit while startup investing, it's important to understand the distribution of venture returns. People tend to group investments into three buckets. The bad companies go to zero, the mediocre ones do maybe 1x, so you don't lose much or gain much, and then the great companies do maybe 3 to 10 times. But that model misses the key insight that actual returns are incredibly skewed. Bad CVs tend to think that all companies are created equal and some just fell, spin wheels, or grow. In reality, you get a power law distribution. Successes are subject to Babe Ruth effect. They strike that a lot, but their home runs make up for it. Okay, I guess that's Babe Ruth law. Babe Ruth. At the heart of every investment strategy are a lot of strikeouts, total a handful of home runs, and a few grand slams. This is hard for more investors because people hate losing money. In fact, behavioral economists have found that people feel worse about losing a sum of money than they feel good when making that sum of money. But to quote top VC Bill Garrett, venture capital is not even a home run business, it's a grand slam business. And when successful investors are pulling in outlier returns on billion-dollar startups' outcomes, the losses pale in comparison to the wins. Founders Funds 2005 fund exhibited parallel distribution. The best investment within the fund produced returns that were worth nearly as much as early other investment with the fund combined. The second best investment was as valuable as the third best investment through the last place investment within the fund. So, um, experienced individual investors and VCs practice diversification to increase their chances of investing in a company that produces an exponential return on investment. Diversification basically amounts to the age-old adage: "Don't put all your eggs in one basket." It is an investment strategy that involves making multiple smaller investments in various asset classes. Rather than sinking all of your capital into a single investment opportunity, a well-diversified investment portfolio will typically include investments in a high-risk, high-reward asset class, like startup investing. Some relatively lower risk, lower return investments. Example: public equity and more stable investments like government bonds. Okay. Within each asset class, investors will invest in a variety of opportunities. An investor has a higher chance of investing in a top startup if she invests 10,000 in 10 startups rather than investing 100,000 in a single startup. Angel investor and founding of Softtech VC, Jeff Clavier, practices diversity in both his personal investment and within his VC firm. Jeff has personally invested in over 20 startups and is known to deploy as much as $6 million in the company he believes in. He also invested in about 160 startups via Softtech VC. Some big names within the Softtech VC portfolio include Postmates, Sheeple, and SendGrid. Investing in multiple startups increases Jeff's chances of investing in a big winner within his personal and institutional portfolios. Most investors have multiple motivations for investing in a startup aside from just pursuing a profit. The rewards of startup investing. Oh, the bad news we're on top. The rewards are here. Diversification. Diversify their portfolio to include high risk, high reward asset class. Entrepreneurial communities. Support new entrepreneurs and help companies that they believe in to succeed. Network. Meet and connect with founders, other investors, and active members of the tech community. Stay up to date with new tech trends and emerging top startups. Returns. Potential to make outsized returns which far exceed returns on other startups of investments. If an early investor funds a very successful startup. Alright, let's take a quick breath. Check UCL. Hope PSG is still going on. That's insane. Kicked Liverpool out PSG. So the big thing that we're in is just it's not a random thing. You need to care so much, and then if you cared so much, you will still end up with making a bunch of mistakes and having a golden puppy. And then the equities. Another important thing is that it's important to the contract thing is that you make up your rules for your selling stock. I didn't know that. That was really interesting. If you're public, whatever stock is out there, your now I'm wondering about like Twitter. Let's see. Okay, the question could be like, can I hope someone else asked selling my Twitter issue to owners. Um, okay, so what will happen to the shares of stockholders who refuse to sell their Twitter shares after Elon Musk's acquisition? When a company's board agrees to revolt, all shares are retired at the age price. Uh, the board acts on behalf of the shareholders. That's that's Elon Musk made an offer significantly above fair market value of shares traded on the open market. A board cannot fail to entertain an offer above the market price. If the buyer demonstrates the financial means to complete the deal, it would be unusual to reject the offer. Can deliver things. Oh, okay. I see. So it's the board. Just get a check. Just get a check. Where's this guy? All right. Yeah. Then you have those things. Probably there's crazy lawsuits. Recent startup lawsuits. Legal battles. The biggest startup lawsuits of what is this? Founders Shoe? Interesting. Um, just released Pip. Alright, too long didn't read. Economic turmoil and AI drive legal battles, investor caution, and the rise of AI have influenced legal issues with lawsuits focused on AI washing and unclear copyright infringement. LifeBrand sued for missing payments. LifeBrand company marketing AI reputation management technology is sued for failing to pay sponsorship fees due to financial difficulties. Perplexity AI faces copyright lawsuit. News organizations sued Perplexity AI for potentially copying their contents through its search engine. Cooley law firm accused of misleading investors. Cooley LLP is sued for allegedly misleading investors about a fraudulent startup, Carbon IQ. Okay. Misleading investors about fraudulent startup. Okay. And OpenAI and Anthropic face copyright infringement. Interesting. So yeah, there's definitely fraud. There's a lot of lawsuits. That's what these guys may exist. Increased regulatory scrutiny and compliance challenges. Regulatory bodies are tightening rules around cybersecurity, data privacy, and AI, creating compliance challenges for startups expanding globally. These are fair. Okay. So we learned a little bit about the lingo, limited partners, general partners. It was 6 chapters, I think, in that website. I'm gonna put the website in the video. And what else? What else can we do? What else did we learn? We learned about the new VCs. We learned about some of the stats. We didn't want the stats, but we're given stats anyways. It's very important to have the data. We learned a little bit why you would want to invest, like loaning. As a start, we kind of get loans. Oh, and then your business is reliable for that loan, not you. You can have that, and then the banks don't do that. So there's that what's it called, advantage to do that. And what else? Let's take a look at our note. The Brad Berham. We had the Yale management, the endowment fund. We had learn a little bit about the founders fund. We saw like the books of the endowment fund thing. Yeah, okay. David F. Swenson, that's the Limited Partner Association, voting powers, how to draft contracts. I see. Oh, as an investor. Okay, that's it for this video. It's not exactly 2 hours. Hour and it's an hour and a half of good content maybe, but it's good amount for today. I'm gonna finish the video.